Okay, you can see the presentation, you can hear me loud and clear, right?
Good to go.
Yes.
Okay, fantastic. So guys, this presentation today is going to be highly educational, be a fantastic learning experience. We're here to discuss an ITPM trader, Stefan, who has outperformed the market in the last 8 months by over 200%. Okay. Bit of housekeeping before we get started. Webinar rules as well. If you are having some connection issues, please do refresh the page on your side before you begin spamming the Q&A area on the right-hand side that you've been using. Or you can actually just go and change your browser. Google Chrome works the best, okay? A reminder, all content today is owned by ITPM. It's our copyright and intellectual property. And questioning, you've obviously experienced the Q&A area now. Please keep questions on topic to the presentation, okay? Of course, you can ask on-topic questions in the Q&A area throughout. Myself, Sheki, and Stefan will be answering questions when we're not actually presenting throughout the webinar. And we've got a Q&A session at the end of the webinar as well. We don't answer nugget hunter or bottom feeder questions. Don't ask us what we think of your latest bad position in a stock, gold, Bitcoin, any of this nonsense. We're just not going to answer it, okay? We're a school, not a copy trading service. So unfortunately, this is a bum-free zone. No bums allowed. Thank you. So what do we actually teach? So from start to finish, there's a process to what we do, okay? This is the process mapped out in terms of the learning experience of a retail trader, okay? So if you look at the green boxes is the process. 90% of what we do is rooted in fundamentals. You guys learn the theory first. What you're essentially doing is you're generating fundamentally driven trade ideas, both longs and shorts, okay? Then you learn how to time those trades. Then you learn how to structure those trades around catalysts in the 20 to 60-day time horizon. And then you learn how to actually trade those positions, how to exit them properly, okay? And then, of course, you end up with a track record because you have statistical significance. This usually occurs over 12 to 18 months. So you're looking at 100 to 150 trades. So all of the infrastructure that we have at ITPM essentially takes you through that entire process. So guys, now that we've got a bit of context into how things are done at ITPM, so you can understand how Stefan came into ITPM and what he learned and what he's doing now, I'm going to hand it over to Stefan, and Stefan's going to take you through his entire journey and all of his trades of the last 8 months. Take it away, Stefan.
Hello, I'm Stefan, and I will start sharing my screen. Can you see the presentation?
Good.
Okay. Yeah. First, I want to tell you where I came from and how I came to trading. Actually, I'm an old school computer hacker. I started in the late 80s teaching myself software development. Then my parents wanted me to go to the university in order to have the boy learn something real. And during my time in the university, I worked as a software developer, and not only for being a financially independent student, but also to save my brain during the stay at the university, because you all know there's nothing real to be learned at the university. And so I worked for 2 different companies, and right after submitting my diploma thesis, I met with my partner at the notary and co-founded my own software company. Actually, I never worked again for another company. So you can regard me as a full-life entrepreneur. And of course, I went through different times with my company. First, we had our phase where we are self-financed via cash flow during the 90s. And the new economy hit, venture capital rounds, preparation of IPO, and unhealthy growth. And also in year 2000 was the one and only year of a loss for the company. So I spent the early 2000s with restructuring and turnaround. But after that, it went really well. And so I could sell the majority of my shares to private equity in early 2020. I had to stay for a while as executive director, and I left my executive position in August 2021. And because I had some money for investing and needed a new thing to do, I thought that becoming a trader will be my next occupation. So since this time, I trade and invest my own money. And because I wanted to do it successfully, I decided to learn how to do it from the get-go. And thus I started the mentoring program with Edward Check. And so next I will show you how this all comes together, all the numbers. And so in order you can follow me and see that everything is real. So I funded my account with $250,000. I put it in 3 different transactions. So in June 21, I put in 100,000, and in July 21, I put in another 100,000. So we have 200,000. And in August, I put another 50,000. So in the end, it's 249,000. And when we go forward to the 29th of June 22, you see my account balance is 422,000. And you have to see that I deducted 150,000 because I needed some liquidity on other accounts. This is the withdrawal I took on the beginning of June. So when we put everything together, the opening balance of the account was 250. The closing balance was 422. I withdrew 150. And so the account value balance was 572. And when we take the initial investment, when we deduct this, we get a profit of 322. And because I only utilized 160,000, this gives about 200% return. Okay. I will show you how these numbers come out. I use a TradeStation account, and I switch over to Excel now, so you can see how these numbers come. This is the dump I get out of my account in TradeStation. You can see the account net worth. For a long time it was the 249, and then in October, when the mentoring program started, I started doing some trades, and we will see all the daily P&L and things like that. And in the end, you can see it's the account value of 422 and the profit of 322. So in order to make this more easy to understand, we created graphics, and you can see on the right side. And because in Excel this is a little tiny with the numbers, we show this presentation later when we go back to the PowerPoint. I will also show you how we at ITPM we take a note of all our trades. When we put in the trade, we use this realized P&L monitor, where we put in all the names where we are trading, if it's long, short, if it's a put or call, and the expiration, the strike, the number of contracts, the price in, and at the beginning we put the same price as we are traded in, and the entry date. And when we exit the trade, we put in the price out and the exit date, so we can get our trading statistics. And you can see there are some trades now, they are ordered by exit date. So you can see these colors show one trade. This was a option spread, and one was exited on the 3rd of November, and one was exited on the 22nd of November. And when you look at the right side, there's the cumulative account, P&L. You can see after half my mentoring program with Ed, I was a little down because there was the Clorox trade, which made a loss. The Beyond Meat trade made a little win. So I was kind of flat after halfway through the mentoring program. And at the end of 21, the mentoring program ended and I was up 60,000. And then I tried it by myself. And you can see the CF trade, Occidental trade, Sandwich. I will come back to some of these trades later so we can look into detail. And you can see this is my high watermark. I had 421 realized P&L, but in the second quarter, I had a little drawdown, about 94. So my current P&L is 327. And I will show you some of the details later. I just wanted to let you know how these numbers are calculated. And we have this spreadsheet where we take track of all our actions. And then we usually have our open trades in this option monitor where we put in all our open positions. We can monitor the current P&L once a week. We can look at it and see if we need to change something. Right now, my book is empty, as you can see. This is because during the summer, I have some bigger project because I want to immigrate. And so I decided to start trading in the fourth quarter again and don't do any trading in the current quarter. Okay, now you have seen it. I go back to the PowerPoint so you can look at these numbers with a little bigger graphics. Okay, this is the graphics of my account realized and unrealized P&L, and you can see it starts, of course, at a 0, and then it's a little up and down, and then at the end, at the beginning of December, I had my first big wins, which put my account up to 100 kilo, and I set up some new trades. They had usually expirations in January, February, and then the mood of the market changed. So at the end of the last year, when you remember, there was a big risk on action. So at the end, most of the stocks that performed not very well in the year changed direction. So I get a little unrealized drawdown. But because because I thought these trades are still valid and had a high conviction, I didn't exit these trades and left them on. And you can see in the beginning of the next year, starting with January and February, I could realize a lot of these trades. And in the beginning of March, I had about 150,000. And then the market changed again because we had all these energy shortage and things like that. And then we had the sanctions against Russia, which also had big turbulence in the market. And I could also make a lot of money out of this. So at the end of March, I was up about 300,000. Then also in April, there was some very good trades. And this is my high water mark. And then I had some mixed performance because the market changed again. And I even did some bad actions, which I show you later. So you can see, even if you don't get everything right, you can still have a decent performance. Okay, now we look at this chart. This shows the account value, not the P&L. So it starts with 250,000 in the beginning. And then you can see the account value changes to the upside, a little down. And after the mentoring, you get again the high watermark, which was 638. Then you can see that I withdrew some money out of my account. This is the 150 kilo. So in the end, you have the 422, which is the final, excuse me, which is the final amount on my account. When we look at this chart, you can see the account performance in percentage of the utilized capital. So I told you that I put in 250 kilo dollars to my account, but I decided together with Ed that I just utilized 150. It didn't be now exactly 150. It was 160 at the maximum. And when we divide the account performance by the utilized capital index, we of course start with 100% in the beginning, and then you can see in the end we end with 300%, which is 200% profit. So this is how the numbers come together. And now let's take a look at my trading statistics. So when we look at the upper part of this, you can see my realized trade monitor, and you can see I did 86 trades. Of them, 52 were winning trades and 32 were losing trades. So in total, I'm gained 680 with the winning trades and lost 360 by losing trades, which gives me R value of 1.9, which means I gain about 2 times with my winning trades than I lose with my losing trades. And here in the right side, you can see the closed P&L. You have to deduct about 5,000 commissions, and then you can see that it's about 200% return on invested capital. And my average day in trades is 36 days. So you can see I'm right in the area where Anton mentioned where the best opportunities are in the trading. Okay, so we can see the realized P&L curve, which is a little flatter because Ed taught me that I should keep my realized P&L at the high watermark, because if you realize losses, it's harder to come back again. So usually when I realize losing trades, I also try to realize winning trades. So the actual realized P&L always goes up, which does not work all the time, but you can see this is lesser drawdown when you compare this to the other charts. Okay, so in summary, you can see my TradeStation account value has 322 P&L. You have seen in the options monitor it was 327, but you have to deduct the commissions, which we don't do in the options monitor because it's too much hassle. You can see it comes to 322 net result. If you take the utilized capital, which is 160,000, you come to a return on 200%. And I also get these statistics. Okay, let's take a look at some of these trades. First, take a look at some of my winning trades. The first short winning trade was Beyond Meat. You know, this is the company that tries to create fake meat, and they actually do create fake meat, but they don't make any money. They just spend the shareholders' capital for marketing. So they announce big deals here and there, And after a big announcement like McDonald's or so, they usually go up a little, but in the end, it will be sold. So actually, after such a rally, you put on a short trade and can make a lot of money with this. And because I'm a computer guy, I had to take some trades in the software business, of course. And we had all these big winners of the COVID phase. You remember DocuSign and Zoom. Yeah, they also don't make any money, at least at this point in time. Of course, they have revenue growth because they invest a lot in sales. So what I could see, even in my company, where I was working in the last year, they sell big accounts and big subscriptions, which we actually don't need. So I guess that at the end of the 1 year period, many of these were not renewed for the next year. So the sales growth will decline. And when you have declining sales growth and make no money, then I think your stocks will be derated. And so DocuSign and Zoom have been very big winners for me. And then you could also see that the energy sector was also being re-rated because there was less investment in the energy space. And also during COVID, the energy usage and also the revenue of the energy companies went down. And so many of them had very low valuation. And you could see that the earnings reviews were rated up. And so I think there was a good catalyst for re-rating of the stock too. And so I did the trades in Sandwich and Occidental Petroleum, which also went good. Actually, the Occidental Petroleum, Ed will tell you something about it, didn't have a good timing in the beginning, but in the end also was a good trade. And then I've learned about the fertilizers business because the price for fertilizers has gone up 4 times, 5 times. And first I went to the quants and all the what we have been told at ITPM, go to the quants of the companies and see which company is a good expression. So I came to Mosaic, which is the biggest fertilizer producer in the world. And then I went to the earnings call, and I've seen the analysts ask them, how do you get your urea, which is a input for the nitrogen fertilizer, and Mosaic does both the potash and the nitrogen. And I thought it was an issue to have the input materials for the nitrogen. And then I think it was the CEO of the company said, no, we are fine. We have a big contract with CF. We get 50% of our input for the nitrogen from them. And so we are fine, and we are not supposed to hire costs. And that's how I learned about CF. I never heard about this company before. So I went to their earnings call, and they talked that in Europe, there's no nitrogen fertilizer production anymore. All the companies are shut down because the natural gas is so expensive. Even with the 5 times prices of the fertilizer, it's still not a good business. And even CF shut down their factory in the UK. And so I thought, okay, this is even a better expression for my fertilizer bullishness. And so I put on this trade, and actually this is one of my best trades, because at the start of the sanctions against Russia, one of the biggest producer for fertilizer is, of course, Russia and also Ukraine and Belarus. And so this company get very high stock price improvement, which I could profit a lot. And then because Ed also discussed with me my trades, and he said I cannot do just energy and tech. I need to go have more diversification to other industries. So I thought real estate may be a good thing, and I did a lot of research with real estate, and I learned that St. Joe's is a very good company for being re-rated, because they have a very low valuation at this time, and they have big exposure to Florida. And I learned that all Americans are moving to Florida, and so they need a lot of real estate there. And so this company has a good position. They are a property developer, so they own a lot of land which they can develop and sell for residential building. They even operate some of their commercial real estate. They have some agricultural stuff. So I thought they are good positioned, and this also went very well and was one of my winning trades. And let's take a look at some of my losing trades. The first was also in the re-rating of all the COVID winners and losers. Clorox, which is actually a consumer staples company, they had a very high stock price movement in the COVID phase, because they built all this cleaning stuff, and they had a lot of revenue growth in the 2020 and 21. And I thought now this has to be rewinded, and they will be a good short. Actually, I was a little too early, because in the year-end risk on movement, they also went up a lot. So this trade went against me, but 2 months later, it did exactly as I thought. But you can see you have to have the right timing, otherwise your good idea is bad. And then I had on the long side of the reopening trade, I had first Expedia, because I've seen that the lockdown in America was removed earlier. In Europe, we were still locked down in the first quarter. So I thought a company which has more exposure to America, which is Expedia, will be good for the reopening and all the pent-up demand for vacation and stuff. And Expedia is positioned as a resale company for American hotel chains. And this trade was first, it went in the right direction, but then there was the Walmart, no, not the Walmart, it was the Marriott earnings call, and they told that they will not have a lot of sales in this year. And because I was a little busy with other stuff, I forgot to exit this trade, and so it went against me, and in the end of June it was a full loss trade. This was not necessary, but it was a bad management of my open book, so this was a loss. And also the same goes for Target, because I thought now as everybody can go shopping again, they will have a lot of revenue growth, but also this went against me, because actually the higher costs, and because of the energy costs and the the sourcing of their merchandise from China went very bad. So they don't have a re-rating to the upside, but to the downside. And also this position was, in the beginning, it was 100% up. And I did a bad management of my book because 5 days before, Walmart had their earnings, and they gave a warning and bad guidance for the rest of the year. And so I should have taken the profit of this position, but I didn't do it, and that's why 5 days later they went down, I think, 20% overnight, and in the end this was a full loss position. And so you can see it's not only enough having a good idea and setting up good trades, you have to stay in motion, and I didn't do this very well in May, and this is the reason why I lost these 2 positions. And also I was a little early with my gold as an inflation hedge, so I set up a trade in Franco-Nevada, and actually this also didn't work out as I expected. Okay, so in the end you can see, even if you have a lot of losing trades, if you do the right management of your book and be long short, then you still can make a lot of money. So let's take a look how I went through the ITPM education. So in May 2020, after the sale of my company, I was still working as executive director, but I wanted to prepare for trading my own money. So I looked through the internet where I can find education, and I thought ITPM may be a good decision. And then there was the emergency room webinar, which was a 2 weeks trade idea generation and option structuring lesson, which was only $1,000. So I thought I can do a low risk sneak preview, and did this war room. And actually it was very insightful for me. So I decided to do the education. I bought the professional trading masterclass and professional options trading masterclass, and also professional forex trading video series, and studied on my own. Then I decided that I have to do it really and do the mentoring program, because I knew that I will exit my employment with my company in mid of 21. I signed up for the mentoring program with Edward Check, and this program would start in the 4th quarter of 21, right after I'm retired from my computer job. And yeah, since September 21, the program started, and since January 22, I'm trading by myself. How do I spend my week? Because I have some more time than I had before. I can spend a lot of time with macro research and things like that, and also I like learning about how the world works and how the economy works. And so I do a lot of research, and usually on Sunday I check the calendar for the upcoming week, because I'm trading in the European time zone. The trading day starts only in the afternoon, so I can also take all Sunday morning for doing some more preparation of the week. And when the trading begins in the afternoon, I'm well prepared. and I do this the idea generation all the week, because I read the macro stuff that comes out every day, and then I take a look at the companies, and so I always have some ideas that I can set up. And the part which takes the less time is the actual execution. Usually setting up positions takes only half an hour, 1 hour per day, even if you try to find a good execution and don't just hit the bid or ask. It doesn't take more than 1 hour per day. And usually it's only 1 or 2 days per week where I do actual trading. On the other days, I just check how the positions are moving, and if something changes, so I have to do something. So actually, I usually do about 20 hours a week, some weeks more, some weeks less. I think if I would not have so much time as I have now, I could also do it in 15 hours, but because I enjoy doing this stuff, I do a little more, even if it would not be necessary to do my trading. Okay, let's sum up how how my trading was before and how was it later. Maybe I stop the presentation now. I don't share my screen, so you can see me. Can you see me? Okay, so prior to the ITPM trading, I also had some money, so I had a long-only stock portfolio where I was doing what Anton said, being an investor. So I just put in some long positions. Actually, these were also good positions, but usually my portfolio went up and down with the market. Even because my understanding of macroeconomics was pretty good, because I didn't have a trading framework, I could not consistently make money. And when the market went down, I had big drawdowns, and also the stock picking process was not very consistent, because I had only long positions, and there was very bad risk management, because the risk management was just having stop loss orders or things like that. And as you know, you get stopped out, and after that, the stock moves in the direction you wanted to have it move, but you are not in the trade anymore. And now I have a very complete trading skill set, which works fantastic. As long as I put in the work to generate trade ideas, original trade ideas, of course, where I have a conviction, so I can stand up the up and downs while I have the position open. I can maximize returns, and I make now money in both up and down markets, and this gives me great confidence. And I'm not sitting there and see how the market works and take whatever it gives to me. So I'm confident and have control of my returns. And I think I need this because I want to trade a reasonable amount of money. And if you have to stand up daily open P&Ls that are in the area of your former monthly salary, I think you need a very good process and good conviction to get this done. And right now, I know what I do. I have experience because of the mentoring program, and I'm convinced that it's just a choice setting up trades and having good profits. And right now, because I know that my concentration is not so good because my immigration project, I stopped trading for 2 months and I'm very sure that I will start again in September and make another three-figure return until the end of the year. Okay.
Thank you. Thank you very much, Stefan. Right, I'm going to share. I'm going to pick up the baton. So for those of you who don't know me, my name's Edward Sheck. I first met Anton back in the 90s, back at Goldman Sachs. You can see my CV there, ran emerging markets trading at JP Morgan, head of trading at BCS, retired, caught up with Anton. He told me all about the amazing work that ITPM was doing, and I was delighted to come on board. So let's get back to the title of this. What does bear market alpha mean? So here we've just got a list of the major indices. So if we start on the left with the NASDAQ 100, the index peak, the index low, max drawdown 32%. Now, during this period that Stefan's outlined from the beginning of October to mid-June, NASDAQ was down 23%, Stefan's up 201%, so the alpha is 225. Beta is obviously just the market performance. Alpha is the extra over or under compared to the index. And obviously you can see the alpha going through the NASDAQ composite, S&P, Dow, Russell 2000, Russell 3000, Russell growth, and poor old Kathy's innovative growth. Okay. Now, if you're just a long only person, how on earth could you have outperformed to this degree? Clearly you can't. Anton's already outlined why we trade long short, why we trade 20 to 60 days, 1 to 3 months. It's as clear as day. There's a lot in this slide. We're trying to run a business. We're trying to teach you a way that you can achieve your financial goals. And the reason why we trade options, not stocks or ETFs, is you can't quantify your maximum loss. That's what most retail do. You're either long stocks or you're trading, you're leveraged, 2 to 1, trading CFDs. And then when the market has a squeeze, if we think of the current market, you are far more likely to get squeezed out when you shouldn't be. 2 reasons. You can't quantify your max loss, right? And secondly, you don't have a stop, which of course is part of the same problem. And so what you'll tend to do is panic when you shouldn't be. You want to sell your longs when the market's selling off. You want to cut your shorts when the market's going up, and you're just doing everything the wrong way round, but you don't have a process. The big problem is you're more likely to trade your unrealized P&L, the one number at the bottom of all your instruments. If you trade that number, you are always going to make the wrong trading decisions. It's not about being unlucky, it's you just don't really know how to trade. So here what we're trying to inform you about is we're going to give you the skill set that allows you to look at the data, know how to interpret it, know what's the right data to look at, and have your view. We don't believe in hyperbolic narratives. If you're listening to Bloomberg or reading all the blogs, tip sheets, you don't understand the difference between being a trader and being a journalist. Journalists look what happens and then find a good story or narrative to relay the facts. Traders look at the right data and make predictions probable as to likely outcomes for different types of instruments. So if you're always looking at the story, always looking at the narrative, you're always likely to get your market timing wrong. So if there is a big shift, quantitative shift based on data in the market will move before the data is apparent. When it's moved half to 2/3, then you'll hear the story. And when we're all talking about the story day in, day out, like you do on Bloomberg News, because after all, if I've got to talk about the market for 8 hours a day, you're going to keep covering the same old stuff. So you've got to be savvy. You need to be educated. We're trading probabilities, not possibilities. We are trading strategies, not one unrealized number. We're long and short because the key to getting very wealthy is not losing a lot of money fast. Okay? Risk-adjusted returns means we might take a bit less of a return, but we sleep well at night. You don't start your day off by looking where S&P futures are and then have a sense that you're going to have a good or bad day. So, key areas of focus during mentoring. Macroeconomics. As I've said, we're focusing on the data, not the stories. We'll show you what's most important. Okay? You follow the data. No one else. You can read as much macro research as you like, and it's very unlikely that two experts are going to have the same view. We can look at Uncle Jerome at the Fed. He's probably a smarter man than me. He's got an army of very keen and smart data crunchers. They've got it spectacularly wrong. So why do we hang on every word? Well, of course, it's important so you listen to it, but you don't just believe everything that you hear. Now, obviously, as Stefan's gone through his trades, we can't go through 16 fully worked out ideas, but I want to make a very important point. On those slides with two lines of explanation, that's only a very small part of that got Stefan to actually executing these trades. There is a macro element to it, okay? Bond market related, data related, expectations of future moves. But what we don't do is say, wow, we think there'll be an inflation rate spike. Let's just sell a bit of loss-making tech. That might be our starting point, but then the real hard work happens, and only you can do that. So when I was working with Stefan, Stefan's producing a write-up on each of his ideas. It covers the quantitative, the qualitative, KPIs, catalysts, duration, risks, structuring, payouts. So it's very, very important you understand this. He's outlined the process so you can see, why do we record everything in the spreadsheet? Why? Because you can't trade risk off your trading platform that just shows one gross sort of unrealized number at the bottom. Not when you're trading options or anything, in my opinion. We do it so we can model. We do it so we can see what our worst case is going to be at the next expiry. There is a purpose to everything we do. So he's explained beautifully, this is the process. You're going to do a trade template, which will give you on a mentoring. You're going to get used to having a systematic approach to every idea. Nothing to do with an article you've read. This is what we mean by you've got to turn up and work. Okay? So he does that. Then we go through the whole process. Then we've got to build the book. We've got to add diversification. When we talk about risk-adjusted returns and risk management, if I go back to the target example, what we really mean is target, you're up 100%, so let's call it 20 grand, and you've got a big catalyst. Earnings. Now let's forget about Walmart reporting the week before. What's your swing factor? If these are terrible, I'm going to go from up 20 to down 20 in a day. My swing factor is 40. So I've gone from an unrealized of up 20, but that's not real, to down 40. Down 20 is booked. The swing on your P&L is down 40. If we'd booked profits on half, you've now made 10 grand. Booked, real. We've now only got 10 grand ahead of numbers. So if you get it wrong, you're going to lose 10. You've booked 10. You've got a zero return, not a down 100% return. This is the sort of process that we will teach you. Trade structuring. Options aren't magic. They can be used in a very, very clever way where we can repair, extend duration, stay in the game, minimize loss. But clearly, don't forget, if it's a bad idea or as part of a portfolio, it's an inventory idea. If the market falls 20%, it is highly likely your longs are going to lose, but your shorts are going to be making a lot more than 100%. They could be making 200-300%. So is that long idea bad? No, it's inventory. It allows you to sleep well at night. It allows you not to look like a crack addict trader on your phone every 5 seconds, as if at any second imminent danger may present itself. That's everything that we don't do. So trade structuring is the expression of your view. There's no magic structure. It all depends which one most aligns with your view. And then we can max out our returns. We know what our downside is. It's going to be one of 12 positions. Now, excuse me, staying in motion. There's a lot of magic in this line. And you really can only do this with live money. Repair, restructure, manage your expiries, stagger your expiries, book the P&L. This is a business. Once a month, we want to know what our P&L is. And when I say what our real P&L is, I mean what's our realized. Of course, we're aware of the unrealized, but that isn't booked. Now all we have to do is decide if we're still committed or if something has changed. And we have a very big monthly option expiry focus. Now, you saw some amazing trades, like in CF, DocuSign. He had some great winners. But now I'm going to actually highlight one of his winners, but it wasn't the biggest by far, but it's certainly the most interesting. Because when you look at Stefan's monitor, it's very easy to think he's made a load of money. We bought puts and the stock went down. Buy them, go straight down, straight away. We're just sitting there smoking cigars, book the profits. We buy calls, it goes straight up. That could not be further from the reality. So before I go into this example, I want to say, if you haven't traded options or you're not familiar, some of this may be a touch hard to follow, but it's not, don't worry about it. I'm just really illustrating of the reality of what it's like when you're trading a book. Every week, we're going through the macro. Every week, we're looking firstly at what's going wrong. And then we decide, and we have a process, 4 different options, for want of a better word. What are we going to do? It's A, B, C, or D. We go through them all. What's your outlook? What's your biggest, what do you think is most likely? What's the probability? And we pick the right action. Okay? It's very process driven, but of course, it's your hard-earned money. You can disagree. You can say, I hear you, Ed or Anton, I get it, but I disagree. I'm not going to do it. That's fine. Our job is not to make you trade how we would. It's to make you think about the possibilities, and then you decide. So, manage risk, stay in motion, trade the probabilities. It sounds all a bit like nice little sound bites, but this is what we mean. So, Occidental. I think he said there was a bit of, we wanted some exposure to oil. We wanted some value on the book. And if you can remember back to Zoom and DocuSign, trades that were very profitable, in the last month of December or the end of last year, there was a big risk-on rally. So a lot of growth names, tech names rallied, high beta names, and value went down. And that's exactly what happened here. Okay, so if you can remember back to his equity curve, we had a nice profit at the beginning, and then it looked like the equity curve was dissipating. So we hadn't booked any losses. We were booking profits. But the portfolio, the live portfolio, what you would have been looking at on your trading platform was negative, almost to the same amount as the positive book P&L. I'm going to illustrate this trade in 2 parts. So we're obviously bullish, so we bought it, stock's gone down. So from the initiation to the December expiry, just gone straight down. Okay. Now, there's no point looking up here saying, goodness me, why didn't you buy another 5 times the position? You would have made a fortune. Obviously, that's silly. Obviously, our crystal ball hadn't even predicted Russia-Ukraine. We trade what we see with a process. We're not doing nothing hoping. just because we've got March options doesn't mean we sit there and say, wake me up in February. Right. Now, this is just a structuring spreadsheet, which of course you'll get on mentoring. Oxy, last trade, earnings had come out. This is just a 2-for-1 ratio calendar call spread. I'm not going through options theory now, but basically we're buying twice as many longs, which are longer dated, at a low strike at the money or lower, and we're selling half the amount near dated at a strike above which we don't want the stock to go above by December. $18,000 net spend, 19 grand on the long option, raising a credit of 875. So this was the trade. Now, if I go back to the sheet, this is obviously starting to go down. When we sell a credit, the most we can make is $875. Okay, we sell it for 35 cents. If it becomes worthless, we collect the full amount. As part of the learning process, sometimes we buy our credits back sooner, and we bought it back at 5 cents because we were still bullish. Because the stock was well below 36, it had almost gone to value. So we just bought it back. So this little 750 is a line item, it's a profit. We ran the long for another week, but just before the December expiry, this March option was down 11,700. Now, what's our option? Cut it, scared to lose another 7. Have the fundamentals changed? No. Do we still believe it? Yes. So what do? Well, we can just run it and hope, or we go through our repair process, and that's what we did. We take the cut. Yes. We booked the 11 grand. Very hard for some retail. Imagine if the stock goes up tomorrow and the next day. You'll be there saying, goodness me, I've sold it at the bottom. Do I buy it now? And you're being really unfair. We don't know, or we're much less certain, where a stock's going in 1 day, 2 day, 5 day. 1 to 2 months, much more certain. Okay? So we cut it. We use the remaining 7 grand to reinvest at the money. So now the stock's $4 lower. It's a big move in a little old value all stock then. So now we think we've still got 7 grand. It's not a question of how much am I going to make? Can I still make money? It's we have got 7 grand invested in this. If I was going to spend 7 grand on an Oxy spread, would I buy the March 31s? Not really, not if the stock's 27. So we reset it. It's obviously smaller because we've got less capital. The original 50-25, now we're at 30-15. All right. Now, at the time, we could see that growth was rallying and value was declining. We also knew that Jerome had just gone hawkish. The Fed has just gone hawkish. This is a big event. We were super confident that tech stocks were likely to sell off and potentially hard once the bond market started to rally. Now, all of our mentoring classes start with good macro understanding. We're not going to do it now, but this has been a conversation that's been going on week in, week out, more corroborative data, higher conviction, trade. Then it's gone against us. Fine, it's a year-round rally. Happy Christmas. We're completely calm. Why? Because we're not trading our unrealized P&L. If we were short CFDs in DocuSign, and we've just got a little 10% cut or whatever is standard, as people think it's good risk management, wow, you just get stopped out. But you're still certain, do it again, get stopped out again. Then you think enough, and then you've got your head in your hands in January, February. It's not because you're stupid. It's because you don't have a better way that's going to protect you from the worst parts of yourself and give you the maximum chance of winning. Now, I have to go back. We've prepared the trade here. Now, of course, the rotation's on. Yield curve's going up and it's steepening. Very good for value and cyclicals, pretty bad for tech. So, of course, DocuSign and Zoom are coming down. We're seeing money move, confirming action. stock starts to rally. Now, the art to trading, or one of the important things, is when something big happens, not a story, data-based, you have got to look at your book and think, does my book have to change? Just because we're 20 to 60 days doesn't mean we bang the book on in November and then think we'll just see what happens, when every day, look at the market now, every day, every week there's a change. Bond market's moving, slowing down. No, we're all right. No, we're not. Think of the narratives around oil. When oil's at 120, everyone's reading research that says oil's going to 80. So funny. Beginning of this week, the first bit of research, in a recession, oil's going to 67. This is how you get whipsawed, by listening to just research. Jobs, it's broking. Their job is to get people to trade as much as possible. Okay, so the market's changing here, so we have the right to reassess our strategy. And Stefan's done a blinder. So this is the repaired trade. Remember, we've had to halve the size almost, and we're now at 27.30. The stock starts to rally. It's now around 35.6. We're more confident with the trade. So now we decide to restructure it. We've already modeled the fact that if the stock really does rally, a lot of the drag in P&L is coming from the short. So we decide we're going to cover the short, or Stefan does, and sell half of the long. So that means we're going to have no short and half the long. If we keep booking losses, remember, we've already booked a 10 grand loss when we repaired it. If we just book this loss, what happens if we're wrong? We'd have booked a 10 grand loss, now a 6 grand loss, and now if this goes wrong, an 8 grand loss. Awful trading. We always shut the door on bad things happening. So we have to sell some of the long, and he's sold enough just to book a nice little profit. We take the loss, we book the profit, so we're adding to the cash register, and then we have the trade we want, which of course is just long 15. And then of course, Ukraine, obviously Russia was a big boost. The trade was going brilliantly well anyway, and then of course straight up and you exit. Why do you exit? Because you've got a 10 for 1 on the last piece. If it's not booked, it's not real. 37 grand on a position that was 4 grand the size. But this is what we did. Put it on, high conviction, goes wrong. Book the credit, give it a bit of time, goes wrong. We could have waited another week and hoped it rallied. So this minus 11 was a bit better. But we also knew that if it carried on going down, what we have left to trade with is going down and down and down. I don't think Anton said, this is what we do. We're going to strap on a load of risk and let's hope it goes our way in the next 5 days. It's the opposite, clearly. It's a process. If it goes up, do we think we shouldn't have done it? Of course not. Because we're not trading charts, weeks, days, ticks. We know what we're doing. We know what we're doing, why we're doing it. So you can see at the end of the day, he made 28 grand off an 18 grand investment, 156. So I think this is a really good example. Now imagine you've got 12 positions and the market's volatile. We go through each one every week in spreadsheets discussing, why is this going wrong? Do we think we're wrong? No. Look at the facts, not the opinions. And then we just execute. You know what you're doing and why you're doing it. Then you can be very emotional about booking a loss here. That would be a problem for a lot of people. For us, this is the job. This is what we do. We keep our trades alive with the best potential that we think, sticking to his analysis. But at the end of the day, this is what you learn during a mentoring, because we can't give you a presentation on 1 million permeables, permutations, possibilities, right? The only way you're ever going to achieve your goals is to trade sizable money. It's going to be impossible if you're going to be panicking when the unrealized big. you're suddenly scared by the reality of a big number. The only way you can go from where Stefan is to 10 times is when you trust your process, when you stick to the way that we're going to show you and you keep doing work. Stock ideas take time. If you've got bad ideas and you're with a mentor, he'll show you how to stem the bleeding, roll it out, give yourself the maximum amount of chance. But it isn't magic. If your ideas are bad, you will lose your money much slower if you're with Anton and I or any of the other mentors. But this is about making money. So be under no illusion. You can do it. We're going to show you how, but there are no shortcuts. And this Occidental summary, this is a perfect example of what it means to be staying in motion, focusing on the process and not the unrealized number. So just to finish the process, practically what it looks like, you can see this was the credit booked. A week later or 13 days later, took the first cut. And then mid-January, took the restructure, exited in March. Okay, so this is how it will all appear to you. So, repeatable process. You trade risk, not P&L. Easy to say, but you need to know how to do it. You want to make a lot of money, you are a risk manager. Okay, I want to also mention something interesting Stefan said. When we started, he said, look, I just want to learn. I hope I don't lose too much money in the process, right? Now, of course, he's made a lot of money. If I'd said to Stefan at the beginning, you've got to make 300 grand in the next 7 months, it would make it much harder. Why? Because the tail's wagging the dog. You're going to cut things too soon. You would have cut Oxy because you're thinking, oh my God, I've got to make 300 grand. God, I could lose another 7 here. All of this sort of thing, right? You'll be structuring too aggressive structures because you're thinking, I need to make 50. And where's my next 100 grand coming from? And it's a very interesting point. You forget about the P&L. You focus on the work and the process, and your P&L will be the max it can be on the basis of the quality of your ideas. And Stefan turned up every week and he did it. Whether we were making money or the unrealized was going against us, he did the same thing. Discipline. You've got to enjoy research. You've got to enjoy wanting to find things out. But he stuck to the plan. Okay? It's not like you're getting cocky because you're up 100 grand, think you're brilliant, think you're a seer, think you're Warren or whatever, and you don't think you're terrible. Your P&L is not linear. Go back to the chart. We had to wait a few months for that macro trade to really play into Oxy, Zoom, and DocuSign. The skill set that he has is markets change, and he has got a skill set that he is applying to the current market. Russia, Ukraine set off a big flow of money into and out of stocks and sectors, and he nailed it, right? So don't think there's a magic bullet, a magic checklist. We're going to give you the core. You've got to do the thinking and apply it to the market you're in, not the market you're reading about. And he's applying his new skills, and that's what's so encouraging. Make money when the market's going up, make money when the market's going down, and smashing it on the way down. If he was long only, what do you think he would have done? He would have been in there with Kathy. Over to you, Anton.
That's great. Thank you, Shecky. Okay, guys, so I'm going to finish things up here, and then we're going to move into Q&A. I just wanted to revisit this slide towards the end that Shecky went through earlier, because there's some important points to make here. You know, if you look at the major benchmarks, the indices, peaks and lows, we're looking at numbers here, like for NASDAQ 100, NASDAQ Composite, S&P 500, you know, we're talking like 25 up to 33, 34% down off the peak. Russell 2000, the same, 32%. Russell Growth, 32%. And then, of course, open quotes, innovation, close quotes, from our dear sister, Kathy Wood, down 76% from peak. What's important to understand here is that all of those peaks to lows happened for the benchmarks, except ARC, which peaked in February 2021, during Stefan's mentoring and trading periods. And if you think about what we do at ITPM, what we teach, and what Stefan's taking you through today, we're teaching, and Stefan was running a long-short equity options portfolio. So he's gone into the market during this time when pretty much every long-only retail investor, every long-only manager, every benchmark is down peak to low pretty big. And even during his program, you know, a lot of these indices were down 20, 25%, and growth, you know, innovation for sure was down more. So you can see the swing factor here, right? It's huge, okay? Because if Stefan was actually still a retail investor like he was before he came to ITPM, he would have actually just been completely murdered in 2021 and 2022. So, you know, as Shecky alluded to, we just don't believe as traders in improbable narratives. We don't believe in any market narratives whatsoever. We try to get ahead of the narrative, okay? So, you know, this is a screenshot that I took. You can see the you know, the ARC performance. If you go one slide ahead, Shecky. This is a screenshot that I took of something I saw online when we were putting the presentation together, just to highlight this example, okay? You know, we don't believe in improbable narratives, and we just make money whether the market goes up or down. We get ahead of the narrative. And this screenshot here, you can see it was taken in September 2021. And essentially, this is Kathy Wood shilling her positions, basically bullshit narratives, right? And at this time, Robinhood was $43.66. If you go online and watch that video, it's very educational. This interview was on Yahoo Finance. Try and look for it. You can see, you know, she's quoted here as saying, we couldn't be further from a market bubble. Go through that interview. If you ever needed an example of improbable bullshit narratives in the market, that's a great example. This is literally the opposite of what we do, guys. So Shecky, if you go ahead again. This is literally the opposite of what we do, guys. We don't get sucked into these things. A lot of retail traders have been sucked in over the last couple of years to believe in improbable nonsense narratives, okay? And you know, the reason why we got Stefan on here, there are lots of guys at ITPM that are pretty successful. The reason we got him on is because he's just a really good example of a student that really diligently implemented what we teach, okay? He's highly competent. You know, he's come out of this now. If you look at previous videos that we've got online, if you look at some of the online programs that we've got, we do mention this thing called the competency hierarchy and apply it to trading. And where Stefan is now, he is basically unconsciously competent. He can do this if he chooses to do this now continuously. He can do this on autopilot if he really wants to. And his statistics really prove it. And he's got statistical significance. So I think it was 86 trades that he's done, which is basically just about there for statistical significance. So it's really not down to luck, okay? He's done this by applying the process and applying skill. So, you know, the seats that we sit in at ITPM, we're pretty privileged because we get to see hundreds and hundreds of retail traders every year, you know, at different stages of their educational journey, where they're going right, where they're going wrong, what positions they've got, what positions are working, what positions aren't. And we get to see all of the behaviors and traits and patterns that just repeat themselves over and over in losing and winning retail traders. Basically, when you come into this, guys, what you've got to do is just learn the right information. And then afterwards, when you implement, you've got to put in the work to achieve the consistency in both in results and returns, okay? There is an initial hurdle here. You know, you have to put in quite a bit of work up front, Stefan will definitely attest to that. You know, he obviously put a lot of work into his mentoring program, and then when he went off by himself, for at least the first 3 months, he was clearly working very hard. You know, if you're running a full-time job, running a business, you've got family commitments, hobbies and interests, you know, for definitely the first 6 months, you've got to raise trading as a retail trader higher in your priorities, in your priority list. So you've got to put quite a bit of work in up front, but it does become easier over time. And as Stefan, as an example today, has done, he's made it normality within a 6 to 12 month period. So basically, normality, what does that look like? Essentially, you're a machine. You're extracting profits from the stock market, and this now is Stefan's normality. So like anybody, you know, in any endeavor, you know, if you want to become successful in something, you've got to put the work in. And in trading, if you want to become consistently profitable, you've just got to do the work. And Stefan has proven that it's possible. You just got to do the work and show up. It's the only way you get consistency. On we go, Shaggy.
It's that.
Okay, great. So guys, we're going to go to Q&A in a second, but just a reminder, I'll be quick on this. Our next Thailand program, if you want to go on a Thailand mentoring program, we've got the October one coming up. I'm booked out for that one, so I only had a few places available, but Ross and Jason are available with some places remaining. And if you go ahead, Shecky, to the April one. And on the April program, that's going to be myself and Shecky in one classroom, and Anthony, Isa, and also Raj Malhotra is going to be there as well. So Raj will have 10 places as well. So if you're interested in the April 2023 program or the October program, just send us a message through the website via the contact form. And again, remote programs. And remote programs were is the one that Stefan completed. So if you go ahead, Shecky, next slide. Remote programs, we've got a lot of spaces available as we're taking bookings early for Q4. So if you get your application in, you should secure the mentor of your choice for a remote program starting in Q4. And if you remember, Stefan started his program in Q4 2021 last year. So at the end of the day, guys, it's a choice. You know, if you want to do this, you can actually do it. You can be sitting here a year from now in a position like Stefan, up a lot of money, acquired a new skill set with a huge amount of confidence that you can keep doing it on autopilot and do it for the rest of your life. So guys, I'm going to leave it there. Let's go to the Q&A. Shecky, you can, that's it, minimize, and then I'm going to see if my camera is going to be working actually. So guys,
yeah,
you can ask questions in the Q&A area, obviously. All three of us are here to answer the questions. If you want to pop some questions in the Q&A.
So I did notice a couple earlier all about, you know, should I be making this in my first year? And triple-digit return trading options is absolutely achievable without taking too much risk. Okay, it's the asymmetry of options and payouts. It's the fact that you can make so much more, the R score, and you saw what Stefan's was. But focus on your education and learning. Don't think about the P&L first, just think about the process. We can't stress that enough. We get this all the time. I need to build my account up, when I get $1 million, then I can make $1 million a year, then I can retire. Just learn the basics, go to school, understand your process, and then understand that you can scale it up without changing the way that you trade. Any there, Stefan? I know you've answered a few.
Actually, I didn't find special questions, but one thing I could amend. So you have seen my trading statistics. I have a very good hit rate, 60-40. So I need only 1.9 for making a lot of money. If you have a different, maybe 50-50, as long as your R factor is above 1, you still make money. And so this is very individual, and you can have a good hit rate, and when you hit, you make a lot of money, and you can have it the other way around. So you don't need exactly the same numbers. You need good trades, and the process brings you the P&L out of your good trades.
Here's an interesting one from Adam talking about the Oxy trade. Let it be clear that I had no input in the restructuring. That was pure Stefan. Okay, when we repaired it together, but when it started rallying in mid-June, Stefan restructured it. Okay, so of course you need your hand holding. That's the whole point. Okay, so half of it is understanding the data, the macro, and that includes the idea generation, and the other half is trading the book. So of course you need someone to show you. So as I said, we're going to show you how we think. This is why we do, or I would do this. What do you think? So it's not about you getting a list of rules and just believing it because Raj or me or Jason or Anthony or Anton tells you it. It's the understanding from doing that cements it in. That's why after such a relatively small time, Stefan is making all the right trading decisions. If you've had no experience, that's great. You've got no bad habits. If you had trading experience, and most of you do, because if you were making loads of money, you wouldn't be here in the first place. So even if you've had bad trading experience, when you are shown how to do it properly, you just take it on board. You can't believe you weren't trading like this in the first place. It's not a hard sell. You just do it because you know it's the right way. Okay? Until you find a better way. We're not saying if you can day trade S&P and make 50 grand a day every day and you want to stand in front of your screen for 10 hours a day and be stressed all the time, we're not making a judgment that's a bad way to live or make a living. That sounds fantastic. Okay, we're just outlining what 100 years of experience between us at the top investment banks and trading places, institutions. This is where we choose to trade. This is what works year in, year out, decades on. Hasn't really changed. The stories change. Trading doesn't change.
I think that the most important stuff that I learned is that you need a portfolio. It didn't allow me to set up just one trade. I always had to bring up some short ideas, some long ideas, and put on a portfolio, because even if you have a very good idea, which I had, they can go 100% loss if there's a bad movement in the market. So you cannot rely that you have good ideas, because even if you have good ideas, it still can go against you. And that's why you need a portfolio, because if you have more good ideas than bad ideas, in the end you will win. But if you have only one trade and it's the trade that went against you, you are done.
So there's a lot of first timers on today, as I've previously mentioned. And we're getting a lot of questions that pertain to looking for a rule book. So there's a lot of questions coming through, like, do you buy in the money options, out the money options? Do you buy out the money options, and how far out the money? All of this stuff, and some other questions as well. It just doesn't work like that, guys. Like, we look at every situation individually, and we make an assessment, and we decide what the optimal structure is for that particular situation in that moment in time is. Okay. And also, you know, it's also built around the catalyst and what we're expecting to come out. Okay, so it can range from all sorts of stuff. But Stefan, you most of your stuff was calendars and verticals, right? During that time?
Yes.
Yeah. So calendar spreads and vertical spreads, and in ratios as well. So calendar ratio spreads.
Actually, at the high volatility regime at the end of the year, it was very hard to find good structures because the options were very expensive, and sometimes I was thinking about just setting up a long because the money you got for your short was so few money, it doesn't worth to take the trade. But usually it's good to have a calendar spread.
So Mark is asking, how soon after completing the Potm course should we book mentoring? You can book it even before you've done the Potm course, because all of the online programs are included in a mentoring program. So if somebody booked a Q4 remote program now, or even a Thailand program in October, you would have till then to do the IPLT video series, the PTM and the Potm, get your trading account open, deposit the money. We always ask for a certain amount of trade ideas before you start your program, like 1 or 2 weeks before, so we can see where you're at, what level you're at, and then you just jump on the phone. But yeah, you don't need to do it at a certain time before, but it's always good to have it fresh in the memory for when you start. Because we do have guys, obviously alumni guys, that perhaps might have done the PTM and Potm like 2 years ago, okay, and then they disappear and come back, and then they want to do a mentoring program. But we always encourage them to go over everything again for a couple of months before they actually start, because it's got to be fresh in the memory. So here's a nice question for you, Stefan, from Gregory in the top right corner there. Did you have any bad behaviors or habits that you had to unlearn to achieve the success? What was the biggest change in your thinking before and after the program?
Actually, because I'm not an experienced trader, I didn't have a lot of bad habits, but I learned some new stuff, like having a long-short portfolio, using the options for not only leverage, but also for risk management. My risk management before was having stops, and they always went against me because there's volatility, and I didn't assess the volatility of the stock. And so actually doing a trade without proper analysis is a bad habit. And because I didn't do a lot of trading before, I didn't have to unlearn it. I just came fresh.
Yeah, indeed.
So guys, we have a question here from Adam. He's saying, I know how to structure a trade and will be happy to learn further. What I don't do now is cut them or restructure them in the same way as you've shown today. Is this a process that's easily taught or learned with logical reasoning behind why to change the position, i.e. a rinse and repeat approach for all options trades? Well, yeah, I would say this, when we see the word all or guarantee or 100% or 0%, it's never the case, right? So you're looking for, again, like a rule or a solution that applies to all scenarios all the time. The Occidental scenario, the Occidental trade, was clearly a situation that Stefan still believed in. He believed that it was right to be long, even though the stock went against him initially, right? If you're in a situation where you're coming into an expiry and you're taking a max loss, 100% of the premium because something's gone against you, if you don't believe in it anymore, you don't just restructure the trade. You would be better off putting the capital into something else that you actually believe in for the next 3 months, right? You can always just cut and move on, okay? That's clearly an option. So no, it's not all the time. But to answer your question, is it a logical process to go through? Absolutely. It's very easily teachable.
you know, why Stefan's in such good a position is over time, the stocks grows. You know, it takes hours to come up with trade ideas. Some people will take an inordinate amount of time. We don't mind, but it's got to get to a point where it's sustainable in your lifestyle. So we're not all luxurious enough. You might not be in a position where you're a retired man with capital and you can trade. So if you're working and you're not going to jack it all in and start trading, of course, you've got to understand that once your book's fully invested or you've got 10 to 12 positions, you really need 1.5 ideas a week to maintain the full book. You need a full book for diversification. No, it's not good to have 2 or 3 positions. Okay, it isn't. You've got no diversification, greater chance of losing everything. With 10 or 12, you've got a lot more protection. So you've got to be long term in your thinking for your business. This isn't make it 200%. This isn't now Stefan's my benchmark. I'm going to judge my success. This is the next 30 years. Over the next 30 years, if you can research a stock or keep up with latest technology, you can do 5 or 6 hours a week of proper work. Imagine how many trades you're going to have at your disposal. You're going to be trading housing from the long side, housing from the short side at some point over the next 10 years. You know where to go. You know if you want to sell the people who grow trees, the people who cut trees, the deck builders, the house builders, the estate agents, the whole value chain. Now, if you're coming to the market, you've got to put in the foundations. There's no point turning up saying, yeah, I know 20 names that my mum knows, for example. You've got to go in, understand the market you're trading, know where the bodies are, and that takes time. If you think after 3 months, boom, you're just going to know all there is about the US stock market, you're obviously very naive, but it's a work in progress. 1 stock a week, that's 50 a year. In 4 years, you've got 200 business models that you understand. We'll have taught you how to interpret data and macro. Then you're on the front foot. Then returns can go up way beyond what even Stefan's making. Because you've got to trade for any day, whatever the weather. You're not trying to twitch or predict the next 3 days. You're just sitting there saying, I'll wait for the data. I see what it's done. I know what that means. I go to my list. I select the right trades. And then you are really front foot trading with all the skill set that you have. That's exciting, right?
Absolutely. So we've got a question here from Raphael Raff saying, when you start your portfolio, do you have to wait to have a certain amount of ideas to start putting positions on? Or can you have just a few, like 2 or 3, and build up from there? Yes, so in the beginning of a mentoring program, you're going to send usually 5 trade ideas to your mentor 1 week before you even jump on the phone, okay? So you're going to be starting off with 5 pretty average, or maybe a couple would be bad, trade ideas. And then what's going to happen is the mentor is going to feed back information to you on call number 1. He's going to identify your strengths and weaknesses, tell you where you're going right, tell you where you're going wrong. You're going to go away, come back, call number 2 with a whole bunch of new ideas, and a bunch of them are going to meet the standard, like the quality standard, to make something actionable, okay? Usually guys will start putting on positions on call number 2 or 3, and you start building up from there. But you know, we aim to have a full portfolio by call number 6 or 7, okay? And then you're going to be trading into and out of expiries, monthly options expiries. But yeah, like if you think about, you know, having a 10 position portfolio and having multiple legs of options for each position, you know, if you've got 10 ideas, you can have 20, 22, 24, 26 legs of options positions. So it gets pretty complicated, right? But going into that, you know, you do need a healthy inventory of trade ideas to be able to enable building that portfolio. Then you build it. Well, you're building it as your more and more of your actionable ideas are coming through. you get to the full portfolio size, but from the moment you have your first position, you're actually starting to have to make decisions on the positions on a weekly basis. But definitely by week 6 or 7, you'll have a full portfolio. You'll be taken through the trade idea generation process multiple times. You'll get it at some point. You'll keep coming back with lots and lots of trade ideas. You'll get them on, get up to a full portfolio. You'll have lots of positions, and you'll be trading them very actively. As you can see with Stefan's 86 trades, where Stefan's pretty much dropped in the average amount of trades for the amount of time that he's been trading. So 86 trades over around 7 months is about right. So, someone's saying that they can't hear me. Can you hear me okay?
No, it's fine.
Okay, all right. 86 trades over 7 months. It's about right. So, you're looking about 120, 130 trades as a mean over the first year, something like this. If you have a really volatile period in the year that you start, then you'll probably trade more. And what was your average days in a trade?
36.
36, yeah.
Right in the middle.
Yeah, right in the middle. In volatile markets, it'll come down. It can come down to like in the teens.
Yeah.
Right? The average can be in the teens. So if you look at, guys over in 2020, COVID in 2020, a lot of the guys at ITPM, their average days in a trade was like high teens. So you can imagine the amount of ideas that you have to have if you're turning over your portfolio this much, right? So you need less ideas in less volatile markets, more in more volatile markets, right? Someone's trying to get hold of your name here, Stefan. Lots of thirsty retail traders going to try and contact you via social media.
I don't use social media. This is
good.
Right.
A social media.
We should have included that in the presentation. Actually, it's probably one of the secrets to your returns.
Maybe, yeah. Don't even have an account at Facebook or so.
And to all the mentoring questions, can you just reach out to Alan? Alan will help you with all this sort of stuff. Try and keep it on.
Yeah, just send a message through the contact form on the website, or just apply through the website. If you go to the navigation bar on the website and just click on mentoring, you'll see all of the mentors there, and you can apply individually for any of the mentoring programs for any of the mentors. Okay. Or you can reach out to Alan as well directly on his email. We'll probably hit you guys up with an email after the webinar as well by Monday evening. Someone asked actually very early on in the webinar if they can get a copy of Stefan's spreadsheet. So I think it might be a good idea if we actually sent that out as a template, as an example for everyone to look at. What do you think? Jackie, should we send it out?
We send a template out. I mean, it's useful just to see what the process looks like from from how you should be recording trades. But obviously, not that I need to say it, these are not live trades. Okay, this is not a book you put on now. So be sensible, right?
Yeah, we just got to be always very careful here, guys, because when we send out information like that, people take it the wrong way. Like retail traders just take things the wrong way, right? So that for example, like Sheki said, we'll send that template to a bunch of guys, and maybe 10% of them will actually think, oh, that's a great trade, I'm going to put it on, right? It's like, it's really silly, because these are all from beginning of October till middle of June. So David's asking, do you recommend a certain type of retail broker account? I'm in the UK. and never tried options before. If you go on our website, David, you'll see on the navigation bar, there's a section called accounts. You'll see the brokers that we use around the world.
You know, to all the questions to Stefan about the emotions of cutting, and I mean, it should be unemotional. It's not hard if you know you're doing the right thing. The whole point is to make money. How are you going to trade $1 million account and be scared to cut anything? It's completely illogical. The more emotional you are, the more out of control you are. Stefan has been extremely calm throughout. Okay? He's calm, the same, making or losing. Not that we did much losing, obviously. But the point is, he doesn't stay calm because he just follows what I say he should do like a robot. I'm outlining principles. He's thinking, mulling, and generally coming to the same conclusion as I. Not because there was anything particularly clever, but it's just logical. It's quant-based. So it's right saying, how do you get over the emotion of cutting? So on a mentoring program, I'll always have one or two who will say something like, I don't like repairing because I think I'm going to be right. And I'll say this, I'll repair 80 or 90 times because I like to make as much money as possible. And a very important part is looking after your losers. Okay. Now, if I had an example that all my repairs looked like Oxy, so they all ended up doubling and the rest, then repairing wouldn't be very sensible. If every time I repair, my stocks get bid for, I might see a theme. But after 30 years, I know that 8 out of 10, we're going to make more money or save money relative to the original 8 or 9 times out of 10. So you might remember the one that did go up like Oxy. Heavens knows how much we'd have made if we had left that alone. But it's easy in hindsight. Okay? So it's probabilities. If I ever think it's no good repairing, I'll stop repairing. So it's not emotional to cut, because when you know it's the right thing and you want to make in aggregate year after year the most amount of money, why is it hard to do something that's good for you? It's a mindset that you only have when you trust your trading system. So cutting is wonderful. And when you know what you're doing, you feel really good after a cut. We're long and short. That means it's inventory, not losing positions. It's inventory. So if you've got a problem because you've got to be right, you just don't understand enough about what we're offering. Because it's about making money at the end of the day, nothing more, nothing less.
And by the way, Shaggy, this obviously ties in as well, for the guys listening, to believing in improbable narratives, right?
Yeah.
It's like, if you stumbled across a trade idea, you go into it, it goes against you, and you've got a write-off. Okay. You've got a decision to make. Do I go back into it? Am I ahead of the narrative here? Do I go back into it, or am I just happy to cut it and move on to something else? Because you can always make your money trading something else, right? The problem is always when you're short of ideas. When you've got no inventory and you're running out of ideas and you're running scared. You're going back into positions because you've got nothing else to do. So you're boredom trading, right? And you're getting sucked into narratives. Okay. Something here I picked up on, Shaggy. Just there's some themes here where people are talking about brokers all the time and commissions and stuff like this. Okay, so one guy's talking here. This is quite typical of a lot of the questions coming through at the moment. In terms of commissions, is it cheaper to trade options? Some other guy was asking about commissions as well. It's dirt cheap everywhere these days, guys. You're just focusing on all the wrong things.
Yeah.
When I asked that question right at the beginning of the webinar today, I said, how many guys are outperforming the market in this bear market at the moment? Very few were making money or making even lower good money. The vast majority were down a lot of guys were down quite big. Okay. If you run around thinking about, am I paying 1 cent or 2 cents for something? it's so irrelevant, because if you don't know how to do what we teach and what Stefan has showed you today, like, the swing factor is absolutely massive, right? The opportunity cost is huge.
So there we go.
Mhm.
Do you think Stefan's been worrying about his com rates? Right? There's a $4,000 there. And we understand why you're concerned about it. Commission free just means you're the product. You'll just take longer to lose your money. We are focusing on this. The whole point of this is not making $2,000 a year. It's getting to a point where the com doesn't matter. So we're focusing here. You're not going to get rich by only paying half a basis point, not 1 basis point. So you've got to focus on where you think, where you should be focusing on. Where's your attention being spent? Is to get this sort of number. Commissions should be a rounding error, a checking query at the end of the year.
Yeah, and actually the commissions are so low, they are neglectable when you compare it to the spread. The bid-ask spread is 100 times the commission, so you can just ignore the commission. Just putting on a trade and exiting a trade costs 10 times, 100 times as much.
Hence the need for good execution, which is obviously covered as well.
Yeah.
Good execution spreadsheets and the like.
Yeah.
But Anton, to be fair,
Can you bring up that?
Sorry?
Can you bring up that slide again? Can you bring up that slide again?
Sure.
The Stefan's statistics on the top. So I just want to make a point that's relevant to this, right? Earlier when we were talking about like cutting losses, okay? Bear in mind, Stefan put 250 in his trading account initially, and he utilized a maximum of 160,000 of the 250. So I want you to focus on one number for a second. The loss number, $361,707.80. Okay.
Yeah.
Do you think this guy is scared of cutting things? Of course not, right? Like, that number proves it. So what you've got to remember is that, if you want to achieve statistics like this, you are going to run a business where you are consistently cutting losses. It's a weekly endeavor. You are going to cut losses all the time and experience them. What happens is you become just hard-coded and relaxed about it because you realize it's just part of the overall business. The difference is knowing what to do, okay? So, when you go through a mentoring program and you experience losses, it's handling those losses and being able to know what the actions are that you take when you're having to deal with them, okay? And many people get this wrong. We get lots of guys with good ideas, but they make terrible trading decisions, and they make very little money. They leave a lot of money on the table, or they trade around flat. Okay, you've got to trade. You've got to trade making good, solid, logical decisions for the business and the positions that you've got. Right. Part of that game is consistently booking losses and managing losses well, okay? And we're very unemotional about it. We're very agnostic. We really don't care. As long as it's under control and our business is looking good. So you can see here from Stefan's stats, right? He's traded 7 months, utilized 160 grand in the portfolio, and he's booked 361,000 of losses, right? Yeah. I don't know how more clear it can be, right? There's plenty of losses.
So Anton, there's one other point I really want to make, and Stefan was a good idea generator, and they were all his own. And as a result, Stefan traded his book very well. If you're just picking trades from tip sheets, social media, heaven forbid, Reddit and all that rubbish, or Bloomberg, the problem is when it starts to go wrong, you really don't know what to do. And when you really don't know what to do, you're going to trade your unrealized number, right? Stefan always knew, it studied, He'd always done the research. He knew why he was in this trade, and more importantly, what was the trigger to prove that this was likely to be right, or what would be the trigger for a potential cut, repair, replace. He traded his book really well because he had done the work. So I could give you, or someone could give you, the best portfolio, 12 stocks in the market. Now, don't forget the DocuSign, Zoom, and Offsea trades. These all went quite far against us in the first month. So if you had just said, if you were short DocuSign because your mate Stefan said, I'm short DocuSign, what would you do? Right? You're just getting squeezed horribly. If you're not trading options, you've got a potentially unlimited loss. You'll be scared it's getting bid for or something just before Christmas. You'll be sweating. You'll end up cutting it just so you can enjoy Christmas. You could have done that on all. But because he'd done the work, had a strong view, understood why the stocks were going against him, decided that it was still fine, very confident that it would unravel, he traded. Now, if he had cut those 3 trades because he was panicking, the effect on his P&L would be extremely large. 25 grand profits become 18 grand losses. You do that 3 times, 4 times, that's 100 grand off the total. He traded 80 times. It's a really good example. Everything matters. You do your own research, you've got a really good chance of trading the book badly. All right. If you just copy trades, you will be flapping when it starts to go wrong, and you won't even realize what the effect on your, your annual, your returns will be over the medium to long term. I mean, this question from Anil, could we have improved on our losing trades? If so, how? And this is the great thing. In hindsight, if you showed me where the stock was, or Stefan, where the stock is now, we could tell you exactly what we should have done. Now, as our crystal ball was in the repair shop, all we could do was go through the process, trading probable outcomes, utilizing our available capital. So would you repair a trade or replace it? It depends what your maximum return is with the new trade. If we can repair it and make 150%, but you've got a cracking new trade, you think you might make 300%, you will know what to do. And that's staying in motion and trading. So we can only improve in hindsight, which means we don't even think about it. That's how you stay unemotional.
Stefan, there's a question here for you. Did you find it daunting to have to book a big loss before you make anything, restructuring, etc.? If you did find it daunting, how do you overcome the emotion? I'm interested to know. That's from Kwan Yu.
Actually, I don't know if you can take this from me, because I put in 250,000 because I thought this is a small amount of money, but still large enough that I would be very unhappy if it's all gone. Then Ed told me, let's just take 150. So I took 150, which is still a number where I would be unhappy if it's still gone. But I was ready to pay this for education. So I said goodbye to the 150 for my first trade.
No, but I mean, the reality is he wasn't, because it's not, because the mindset, the quants, the spreadsheet work, we know why we're doing it. We always emphasizing, us mentors, we're trading the strategy.
Yeah.
Okay.
So I was thinking that I'm okay. Then if I have, after 1 year, I still have 150, I would say, okay, this was a good learning and it didn't cost anything. I didn't expect that I will not have a big drawdown. So this is, but the strategy and the process prevents having big drawdowns, because you have a portfolio on. You repair the trades when they went against you, and it's very improbable that they all go against you at the same time. So actually, there was no real risk losing all the 150, even if I would be fine for learning. But actually, when I look from the hindsight, actually there was no real threat losing all of this money.
See, this is quite interesting, guys, right? It's like Stefan's mentality before the program coming in was kind of like, I'm going to be paying losses for my potentially for my education.
Yeah.
And it's almost like, like I alluded to earlier, we sit in this seat at ITPM where we see hundreds of retail traders coming in. And I speak to retail traders throughout the week all over the world, okay, all year. And there is definitely this mentality because people have been burnt in the past, or they're very unsure of themselves, that they're going to come in potentially and just lose some money, to find out how things work. And people are just very kind of like in this mindset because they've existed in a world for so long where they don't know what they're doing, and that everything must be really difficult in retail trading. Everything's a scam. Everything's a mess. What everybody is essentially is that they're in bad habits and they're in losing habits all the time, over and over and over, losing habits. They're doing the wrong things over and over and over again. And they're essentially what we call at ITPM, lossaholics. They're kind of like addicted to losing. Like every action they take in the market is something that's going to cap their upside and create massive downside, right? And people come in with this idea that we're going to put like 160 grand in it or 250 grand in a trading account, and I'm prepared to lose 50 initially to learn, but as long as I make money over time, it's okay. You just don't have to. Like, there is a totally different side of the market, which is the professional side. And like Stefan's shown you today, you can build portfolios in equity options, and you can ensure that you don't have big drawdowns. You are in control of it. It's just knowing how to do it, understanding how to do it, the dynamics and how everything moves. Once you see it on demonstration in a mentoring program, it all just falls into place. As long as you do the work. If you don't do any work, nothing's going to fall into place, right? So we rely on you to do the work. We can't force you to become good traders. You have to do that yourself. Yes, Thomas has just come in and says, now that I think of it, I've lost enough to pay for a mentoring program. Yeah, of course.
And just on the back of that, whether you choose to do a mentoring program or not, or get an education here or not, if you've been trading and you're always losing money, and you may be losing not so much as you used to, but when you're making money, hand on heart, it feels more like luck than anything else. If you don't change your process, the outcomes will not change. Yeah, you might do better slightly at times, worse than others. But if you've had a sort of a series of years of failure from a profitability, you need to change how you're doing it. You're not going to tweak it and somehow the keys to the kingdom land in your lap, right? And you're just suddenly smashing it out of the park. You need a new way to trade. So you've got to answer your own question. And as Thomas says, he's certainly not in the minority. But remember, if you're paying zero comms, cool, that's going to help out over the next 10 years.
So I speak to a lot of guys, retail guys, during the week. Okay, and one of the patterns that I see all the time is guys who have been operating as a retail trader for, say, 3 years, 5 years, 10 years, and they've never made money. And we ask them what they've done, and they go through like all the strategies that they've tried, right? And typically what we see is a lot of guys, what they're trying to do all the time, and it's logical to do this, okay? I'm not saying it's bad. It's actually quite logical to do it, given the information that retail traders have out in the real world, okay? What they're trying to do is operate based on the information that they've got in implementing a strategy that's out there, that's available for retail traders. When it doesn't work, they move on to another one that's available for retail traders, then move on to another one, then another one. And what they're trying to do is trying to make something stick. So they're trying to change their process, iterate. When something works, when they're making a bit of money, they keep iterating. It's logical to do that, to try and refine the process, right? But there's a big problem with it. They're all operating in time horizons that don't work, right? So the volatility of the asset prices that the assets that they're trading over the time horizons that they're trading them, okay, they have no clue that, you know, if you're operating in the 1 day time horizon, or 3 days or 5 days, okay, eventually you're going to come unstuck. So you can iterate as much as you want. You can try to refine your process as much as you want. The problem is the dynamics of the market dictate that you can't make money over time. You can't. The process doesn't stand the test of time. So we see a lot of this. I speak to guys every week who do this, you know, and I communicate to them back, like, you've done nothing wrong. Given the available information that is out there for retail traders, you've actually taken a logical approach. You know, I'm going to put 25 grand in a trading account. I'm going to try this. Okay, I've lost 2 grand and I've done 50 trades. It doesn't work. I'm moving on to this one. Okay, now I'm up 3 grand doing this. I'm going to try and iterate. Oh shit, I'm down 10 grand, right? And they're just all operating in the wrong way. Okay, but you know, most people that we speak to are fairly logical and quite smart, but they've just not found out how to do it properly. Yes, Peter's saying a lot of retail traders are simply on the hamster wheel. Correct. Absolutely. While trading options from Christopher, while trading options, is it still a good idea to have a long-only investor's portfolio? That's not a bad thing at all.
Yeah.
Not a bad thing at all. You know, if you run a trading account and you do it properly, and you have an investing account as well, I can tell you one thing that's going to happen to your investing. You're going to become a way better investor, much better investor, for a number of reasons. First reason is, it should be really obvious. If you identify good trade ideas, and then after 60 days, they're big winners and you take them off, and you don't want to go back into them as a trade for the next 60 days, you might consider them as an investment. So your trading account almost becomes like a petri dish for discovering new investments. It's a great way to fund your investing account for sure.
Good. Stefan, any final comments that you'd like to make?
No, actually, I think I said everything. I think that the most important stuff is that you know your time frame, and you put your emotions in sync with your time frame, and that's what the process gives you. Because you need to select the time frame, because the options have expiration, and you cannot do the wrong thing if you do it with this process.
So questions drying up there, Shaky?
Yeah, I think we addressed the relevant, the pertinent ones.
Okay, guys. Well, we're going to finish things up here. So thanks for showing up today. Hope the information that's been relayed today was useful. Stefan, as you can see, has done extremely well at ITPM. Obviously and honestly, not completely typical of everyone at ITPM. But you know, if you turn up here and you do the work, landing between 50 and 100% in your first year is completely realistic and achievable. As I said earlier in the webinar, you know, the 100% isn't a ceiling, and Stefan is an example of that. There's plenty of guys that get over 100%. But if you show up, you learn the information, you're diligent, you're conscientious, you do the work, you can do very, very well here, okay? So, guys, thanks for coming today. And hopefully we'll see you at ITPM soon in some capacity. And I think now, what is it now? 11:30 in Thailand. I think I'm going to go out for a little drink before bed. So Stefan, thanks for helping out today. Very much appreciated. And Sheki, as always, thank you. Gentlemen, ladies, thank you for coming. Take care.
See you.
Bye-bye.
Bye.